Our next guest isn't waiting for the Fed to start cutting rates to deploy cash, and he's finding opportunity in three areas in particular. One is AI-related, of course, as Nvidia is once again the world's most valuable company. Let's bring in Kevin Mahn, the Chief Investment Officer at Hennion Walsh. Kevin, great to have you with us.
Thank you, Melissa.
You've got to be invested in Nvidia. I mean, these days, any money manager, any portfolio manager worth his salt has to have some exposure. Otherwise, you're underperforming. Is that right?
Absolutely.
I mean, that's probably the hardest trade to be in at this
Absolutely.
point.
And Nvidia is the poster child for the AI boom, and semiconductors and chips are clearly leading the way. But I think most investors now, Melissa, are trying to find the next Nvidia. And that could potentially get them into trouble, as there are so many different investment opportunities that surround the AI ecosystem beyond just Nvidia. One of those areas is data centers. And guess what? Nvidia just reported that they experienced a 400% year-over-year growth in their own data center business. Data centers are the nervous system of the AI ecosystem, as they allow these companies to store and process the massive amounts of data necessary for these AI algorithms. A couple names that come to mind are Digital Realty. They just announced a $7 billion joint venture with Blackstone to build data centers across the world. And then you have a company that's reinvented themselves like Iron Mountain. They're now in the data center business. Data centers are where the puck is going, and they also offer some attractive yields.
From a discipline standpoint, Kevin, would you say that you would want to pare back on Nvidia at this point? Are you concerned about a digestion period in terms of the AI spend? Are you concerned about slowing growth rates for Nvidia? Is there anything about the Nvidia story that worries you given the trajectory it's been on?
Clearly, it's overvalued from a price perspective, but there's no stopping it, Nvidia. They're not satisfied here, and they continue to deploy their own excess cash on their balance sheet for those next generation chips and also into their own data centers. You know, I often like to talk about baseball or sports analogies in general. And people have asked me in terms of the AI game or with Nvidia in particular, what inning are we in? Melissa, I still think we're only in batting practice of a doubleheader. So there's so much more runway ahead, but there's more opportunities than just Nvidia. In fact, why not look at Taiwan Semiconductor, the largest dedicated chip foundry maker in the world with a 40% market share? Or how about in industrial companies that services data centers, such as Vertiv Holdings, which is up nearly 100% year-to-date itself? There are other investment opportunities beyond Nvidia, but that doesn't mean that you necessarily get out of your Nvidia position altogether.
So you mentioned this whole AI ecosystem surrounding Nvidia and sort of all the tentacles that surround it. But at what point do you need to see the return on investment from companies buying the chips? And I'm not talking about the hyperscalers necessarily, but just the ordinary industrial companies, the insurance companies. When do we start to hear about what they're getting for the spend? Because we're going to need to hear that in order for the spend to continue.
Yes, and we're going to need to be patient in that front. What concerns me more is those companies who aren't investing in AI right now, who aren't looking to adopt AI to make themselves more profitable and more efficient. But if they are investment and they are committed to those investments, they will see dividends down the road, no pun intended. But we have to be patient there.
All right. And on the consumer front, because we were just talking about retail sales, any worry about the consumer? Because all this is going to feed back into that AI ecosystem, which you so love.
I am concerned about the consumer. I think the long-awaited economic slowdown that the Federal Reserve has been trying to engineer may be starting to come to fruition now, Melissa. We saw GDP growth slow to 1.3% in the first quarter. We saw the JOLTS report hit its lowest level in the last 3 years, and today's actual retail sales report coming in below expectations. That's all important because the consumer accounts for 70% of our economic growth. And if they stop spending and they shift to servicing all that outstanding debt, the economy can only slow further. But the Federal Reserve realizes that. That's why I believe with the other guests that we still may get 2 rate cuts this year. But even if we don't, rates should still be 225 basis points lower by the end of 2026, according to the Fed. And if that holds true, that's a tailwind for both stocks and bonds.
Kevin, great to see you. Thank you.
You as well. Thank you.